queue for the second half today will be the Monetary Policy Committee of the Reserve Bank India, which is due to review its first bi-monthly monetary policy today. All eyes will be on the steps that the central bank may announce to suck out excess liquidity, boost credit offtake and tackle bad assets in the banking system. Latha, what exactly should one expect and what's on the cards?
Well, our poll, the one that Ritu did, indicated that nobody's expecting any rate action. So that's out of the way. But the language on inflation will be very closely watched because bond yields will want to know how they should move for the rest of the year. So if it does sound that they're extremely worried about inflation, speak about possibility of an El Nino, possibility of food prices rising, then the market will take away from it that for the rest of 2017 there could be rate hikes. So the language will be very important. Also, along with that comes this time around in April and September an MPR, or a monetary policy report, which is the combined wisdom of the Reserve Bank on how it forecasts inflation and growth over the next 12 months. Although that is not policy, that is just the research team's report. It nevertheless is another important point to watch. But all this will be less important than what the Reserve Bank has to say and do about liquidity. Until now, it has always said that it will bring liquidity to normal. Now, what do we mean by that? As of today, every day and through different term repos, the Reserve Bank absorbs money. Banks are sitting with about 3.5 lakh crore of cash, which they don't know what to do, and that can crash rates in the system, in the interbank market and the bond market. So RBI absorbs it in its reverse repo window at 5.75% and through variable rate repos as well. Now, in spite of this absorption, what we notice is that a lot of the T-bills, which are, bonds under 1 year, are trading below the overnight repo rate of 6.25. Normally that should be the lowest rate. And, a 1 month, 1 day T-bill, a 2 day T-bill, a 1 month T-bill and a 1 year T-bill should trade above it. It's trading below, indicating the pressure of liquidity. And it'll be very awkward for the Reserve Bank to say that I am hawkish, I've moved from accommodative to neutral, but a bunch of paper is trading below my policy rate. So they may feel that it is important to maintain their credibility to take out that liquidity, and the only way they can do it is through a CRR hike. Now, even our Ritu's poll indicated that 10% expect a CRR hike. That will be damaging for banks and damaging for bond markets. Damaging in the sense there will be a very big hiccup. So they may not use that Brahmastra, as it were. They may look for other instruments. They can't do an OMO because they don't have that many bonds. They're giving all those bonds as collateral and taking money in the reverse repo window. So, therefore, the expectation is that the government is going to announce a new deposit facility called the standing deposit facility, where the Reserve Bank can take money from banks without giving collateral. At the moment, under RBI Act, the Reserve Bank can neither give money nor take money without collateral. So that has to be amended. It's not come. Now, if it's not come, how can the RBI talk about it? It's not good in form. They can't refer to something that's not legislatively available. So what will they do? How will they reconcile this contradiction of a neutral policy but excess liquidity? That is going to be the key watch. And if they do something to make their policy look consistent and remove that liquidity even in a semi-permanent manner, that might hurt the markets in the short term. We'll have to wait and see. Of course, the other big thing is if they say anything about NPA resolution.
So the probability of an SDF could be lower than what
they can't announce legally an SDF because the RBI Act has to be amended. Yeah. Well, you're free to allude to it. Maybe in the press conference, people will ask them, and they will say that that it is in the hands of the government, or we are in discussion or something. It depends on their comfort zone. If the government has given them an assurance that an ordinance or an amendment act will be moved, then they may confidently say that. But typically regulators will not speak about what is government domain. Okay. So I don't know, maybe they will hint at it. But this is going to be really crucial because it can turn bond prices lower and thereby hurt the mark-to-market gains of banks.
Okay, so no rate cuts, but liquidity will be top of mind. Thanks, Latha, for that.